There are 5 CRA rule changes that took effect in 2026 that are directly affecting how much money lands in your account every month. Not indirectly, not eventually, right now. And here's what makes this genuinely dangerous. Most people receiving CPP, OAS, and GIS have no idea any of these 5 rules exist, because the CRA does not send you a letter explaining how each change affects your specific situation. They update the rules, they update the system, and then they wait for your tax return to arrive and process the result. If the result is less money for you, less in your monthly deposit, less in your benefit entitlement, more withheld from your pension, you find out when the number is different, not before, after. Stay with me, because before this video ends, I'm going to walk you through all 5 changes, what each one is, how much money is involved, and exactly what you can do this week to make sure each one is working for you instead of against you. And I'm going to show you something at the end that connects 2 of these 5 rules in a way that almost nobody is explaining. A connection that for some of you could mean the difference between qualifying for GIS and losing it entirely. Subscribe right now and hit the bell. CRA rules change significantly in 2026, and the agency does not send personal explanations when those changes reduce your benefit entitlement. Subscribe now. Now let me show you exactly what changed and what it means for your money. Hook number 2, and this is the number that makes the rest of this video worth watching. The CRA government lowered the bottom federal income tax rate to 14% from 15% as of the beginning of July. That is the first time the lowest federal tax rate has dropped in decades. For a retired Canadian whose entire income falls within that lowest bracket, CPP, OAS, pension, that one change is worth real money. The tax break will be worth up to $2,303 in 2026 for most Canadians. $2,303, not a refund you have to apply for, an automatic reduction in the federal tax withheld from your income, meaning more money stays in your account every month without you doing anything at all. La voz del desierto, la voz del desierto. But here's the problem. For some people, that money is arriving automatically. For others, it is not, because a withholding form that was set up years ago under the old 15% rate has not been updated, and the CRA will not call you to tell you the form needs updating. Tell me in the comments right now, did you know that the federal income tax rate dropped from 15% to 14% in 2026 dollars? And did anyone explain to you what that means for the withholding on your pension or RRIF withdrawal? Yes or no? Drop your province below. Hook number 3. Here's what almost nobody is connecting about these 5 changes, and why the order you hear them in matters. These are not 5 separate updates that each affect a different group of people. They are 5 changes that interact with each other, and for some people the interaction creates a benefit, while for others it creates a trap. The tax rate drop that saves you money can simultaneously push your net income into a range that affects your GIS. The OAS clawback threshold that gives you more breathing room can interact with the TFSA limit in a way that changes your strategy. Understanding each change in isolation is not enough. You need to understand how they connect. That is what this video does that most coverage of the 2026 CRA changes does not. Here are the 5 CRA rule changes that are affecting retired Canadians in 2026 US years, and exactly what each one means for your money. The first change is the one with the largest immediate impact for most people on fixed incomes. The CRA government lowered the bottom federal income tax rate to 14% from 15% as of the beginning of July. This means 2026 will be the first time that the lower tax rate applies for the full year. La voz del desierto. In practical terms, this means that every dollar of taxable income you receive within the lowest bracket, income up to $58,523 doctus stocks, is now taxed at 14% instead of 15%. For a retired Canadian whose CPP and OAS combined put them in that bracket, the annual tax saving is approximately 1% of their total taxable income in that range. But here is what most people do not know about how this interacts with their monthly pension deposit. If you receive a pension from a former employer, or if you take regular RRIF withdrawals, the amount of tax withheld from those payments is based on instructions either you or your administrator provided, often years ago, under the old 15% rate. That withholding instruction does not automatically update when the tax rate changes. The CRA adjusts the rate. Your withholding stays at the old level unless you file an updated form. The form is called a T1213. A request to reduce tax deductions at source. If you are currently having more tax withheld from a pension or RRIF withdrawal than you actually owe CRA, because the withholding was set under the old 15% rate, filing a T1213 with the CRA can reduce that withholding immediately. Instead of waiting until you file your tax return next April to get a refund of the overpayment, the reduction happens monthly. For some people, that is $100 to $200 more every single month, not at tax time every month, from income they were already receiving. The second change is the one that gives the most breathing room to people with moderate investment income. Old age security recipients encounter a raised clawback threshold of approximately $93,454 in net world income for 2026, delaying the 15-cent per dollar repayment until higher earnings levels. Ambito. The OAS clawback threshold, the net income level above which the CRA begins recovering 15 cents of every OAS dollar, rose from last year's level to $93,454 in 2026. That increase means that a senior whose income is between the old threshold and the new one no longer has any OAS recovery tax applied to their deposit. The money that was being withheld automatically stops being withheld, and their monthly OAS deposit increases by the amount that was previously being recovered. In real numbers, a senior whose net income last year was at the old clawback threshold could see their OAS deposit increase by several $100s per month, starting with the July adjustment, simply because the threshold moved above their income level. That is money they were entitled to all along. And it arrives automatically, unless their 2025 tax return has not been assessed yet, in which case the July adjustment may be delayed. The third change is the one that creates the most confusion because it sounds like a benefit but contains a hidden trap. The TFSA limit for 2026 remains $7,000. That means Canadians who have never contributed to a TFSA and were born in 1991 or earlier would have a cumulative TFSA contribution limit of $109,000 as of January 1, 2026. Lavos del Desierto $109,000 of TFSA room. For many Canadian seniors who have not been maximizing their TFSA, that is a significant amount of space to move income-generating savings out of taxable accounts and into the shelter of a TFSA, where the interest, dividends, and capital gains generated are completely invisible to the CRA. They do not appear on your tax return. They do not affect your net income. They do not trigger the OAS clawback. They do not reduce your GIS entitlement. Here is the connection that most coverage of the TFSA limit does not explain. Net income calculations for eligibility improve outcomes for fixed income seniors. Every dollar of interest income you move from a non-registered savings account, or GIC, into a TFSA is a dollar that disappears from your CRA net income calculation. And every dollar that disappears from that calculation reduces the risk of triggering both the OAS clawback at $93,000 and the GIS reduction at $22,500. One move, transferring savings from a taxable account into a TFSA, can simultaneously protect your OAS and preserve your GIS. For a senior whose net income is close to either threshold, that one decision can be worth thousands of dollars per year in protected benefit entitlement. Ambito. The fourth change is the one that affects everyone who still has an RRSP or is making RRIF withdrawals. The dollar limit for contributing to a registered retirement savings plan in 2026 is rising to $33,810, up from $32,490 in 2025. Canadians can contribute a maximum of 18% of their earnings from the previous year, up to the annual dollar ceiling. La Voz del Desierto. For most retired Canadians, the RRSP contribution limit is no longer relevant. They have converted their RRSP to a RRIF, or they have stopped contributing. But for the group still working part-time while collecting CPP, and for their spouses, the increased RRSP limit creates an opportunity. Every dollar contributed to an RRSP reduces taxable income for the year of the contribution. For a senior or near senior whose combined income from CPP, pension, and part-time work is approaching the OAS clawback threshold or pushing them out of GIS eligibility, an RRSP contribution this year can pull their net income back below the threshold, protecting benefits that are worth significantly more than the tax deduction alone. And for those already in RRIF territory, which means mandatory withdrawals every year, the 2026 federal tax bracket changes mean that each dollar of RRIF withdrawal is now taxed at 14% rather than 15% at the lowest bracket. That is an automatic 1% improvement on every dollar withdrawn. For a RRIF that generates $30,000 in annual withdrawals, the tax saving is approximately $300 per year, automatically, without any change to your withdrawal strategy. The fifth change is the one that most people receiving pension income from a former employer have never heard about, and that the CRA changed quietly effective March 12, 2026. Starting March 12, 2026, banks will be restricted in how much they can charge customers for non-sufficient funds in their personal accounts, capping that fee at a maximum of $10. Banks also cannot charge more than one NSF fee within 2 business days, or charge NSF fees on accounts that have less than $10 of authorized overdrafts. Lavos del Desierto. This is not a CRA tax rule. It is a federal banking regulation that directly affects the money that stays in your account when your pension deposit is delayed or when an automatic payment processes before a deposit clears. For years, a single NSF event could cost a Canadian senior $45 in bank fees on top of the returned payment charge from the creditor. As of March 12th, that fee is capped at $10. One declined payment, one NSF, maximum $10 to your bank. In real terms, for a senior whose CPP deposit was delayed by 1 business day and whose hydro payment processed before it arrived, the difference between the old NSF fee structure and the new cap is potentially $35 per event. For someone whose account runs close to zero before the pension deposit arrives every month, that cap is meaningful, and it is automatic, no application required. Every Canadian bank is now legally required to comply. Now here's the part most coverage of these 5 rules completely misses, and this one connection changes how you think about 2 of them simultaneously. The tax rate drop from 15% to 14% reduces your federal tax on income within the lowest bracket, but it also, for seniors near the GIS threshold, slightly changes their net income calculation in a way that can affect GIS entitlement. Here is how. GIS is calculated based on net income from your CRA return. Net income is gross income minus deductions, including the federal basic personal amount and other allowable deductions, but it is not reduced by your federal income tax. Tax owed does not reduce net income for GIS purposes. What changes with the tax rate drop is not your net income directly, but your overall tax position, which can affect how much you withdraw from a RRIF, how much you take in part-time income, and how much room you have before crossing the GIS threshold at $22,500. For a senior who is currently receiving GIS and who has been taking small RRIF withdrawals to cover expenses, the lower tax rate on those withdrawals means each dollar costs you less in tax, but it does not change the GIS reduction. Every dollar of RRIF income still reduces GIS by 50 cents. The tax saving on the withdrawal does not offset the GIS reduction. And for some seniors, the net effect of taking a RRIF withdrawal, even at the new lower tax rate D, is still negative once the GIS reduction is factored in. Moving that same money into a TFSA, where withdrawals are invisible to the CRA and have zero effect on GIS, remains the more powerful move. That interaction between the new tax rate, RRIF withdrawals, GIS reduction, and TFSA sheltering is the calculation that most people never run before making decisions about their retirement income. Now you have the pieces to run it. Did you know that the 14% federal tax rate, the raised OAS clawback threshold, the $109,000 in cumulative TFSA room, the new RRSP limit, and the NSF fee cap are all in effect simultaneously in 2026, and that the interaction between the tax rate change and your RRIF withdrawals can still leave you worse off if GIS is part of your income picture? Drop your answer below right now. I want to know how many people watching this had any idea all 5 of these changes were affecting their income at the same time. 3 steps you can complete this week. Step 1. Log into my CRA account at canada.ca and look at your current tax withholding on any pension, RRIF, or registered income source. Compare the withholding percentage to the new 14% lowest bracket rate. If you are having more withheld than you owe based on your expected 2026 income, and for most people on fixed incomes, the answer is yes. Download Form T1213, the request to reduce tax deductions at source, and submit it to the CRA. This form is free, available on canada.ca, and can reduce your monthly withholding immediately, putting more money in your account every month instead of waiting until next April's refund. Step 2. Check your available TFSA contribution room through my CRA account. If you have unused room and you currently hold savings, GICs, or investment accounts outside a TFSA that are generating interest income on your CRA return, moving that income into a TFSA removes it from your net income calculation, protecting both your OAS entitlement and your GIS eligibility simultaneously. Call your financial institution and ask them to walk you through moving non-registered savings into your TFSA up to your available contribution room. That one call can have more impact on your annual benefit entitlement than any other single action. Step 3. Share this video today with one person in your life who receives CPP, OAS, GIS, or a pension from a former employer and who has never had these 5 changes explained to them together in one place. That person may be over-withholding on their pension right now, missing TFSA room that would protect their GIS, and unaware that their bank's NSF fees just got capped at $10. One share from you changes all of that. One more thing before we close. The CRA will never call you demanding immediate action on any of these 5 rule changes. They will never text you asking you to verify your tax withholding by clicking a link. They will never threaten to suspend your OAS or GIS unless you update your information by phone. If you receive any contact like that, hang up immediately and call the CRA directly at 1-8009-598281. Real rule changes take effect automatically through the CRA's systems. They do not require you to respond to an urgent phone call. What surprised you most in this video was that the T1213 form that can increase your monthly pension deposit immediately by reducing overwithholding, the $109,000 in cumulative TFSA room that can protect both your OAS and GIS simultaneously, the connection between RRIF withdrawals and GIS reduction that the lower tax rate does not fix, or the NSF fee cap that took effect on March 12th and that every Canadian bank is now legally required to follow. Drop your answer and your province in the comments right now. I read every single one. And if this video helped you, hit the like button right now. 1 second. It is the only way this reaches the next person whose monthly deposit is being reduced by a rule they did not know changed in January. 5 rules, all in effect right now, all affecting the same monthly deposit. None of them explained to you personally by the CRA. The tax rate that dropped, the clawback threshold that rose, the TFSA room that keeps accumulating, the RRSP limit that increased, and the NSF cap that your bank is now legally required to follow. You now know all 5, and you know the one phone call, the T1213 form to your income administrator, that can put more money in your account this month without waiting until April. I am Henry Jaden. Take care of yourself.